Hi, everyone. This is Loretta Sernowski from Remax Fine Properties. Today on our show, we have a people sometimes think it's boring, but when you need to make a decision like selling your home in the United States, it might be boring, but you have to listen because it affects your net dollar at the end of the day. And that's what we're here to talk about. You know, what's that old saying, Doug? There's one thing in the life that doesn't change or whatever, something about taxes.
That's right. Death and taxes.
So today we have Doug Kingston on. He is a CPA here in Arizona. Can you give us a little bit of a background about yourself, please?
Sure, I'm a CPA in Arizona and the state of New Jersey, where I'm from New York City. But anyway, I've lived here for 20, 30 years. I've always been a U.S. international tax specialist, starting with the mega large accounting firms in Brussels, New York, Boston, and Chicago. Um, Moved here for family reasons 25, 30 years ago, and yeah, I'm still here. I'm self-employed with one employee. I've had two employees at one point. All of my clients are cross-border in one way, shape, or form. The vast majority are Canadians selling their U.S. real estate. You know, that would be second home, or sometimes it's an office building or an apartment building. But anyway,
So,
Canada is my bread and butter nowadays.
that's good. Well, we appreciate all your advice. But before we dive into the taxation, because you're from that area of the United States and we just got through the Stanley Cup final, which, as you know, is Canada's love is hockey. So, are you a hockey fan?
On the periphery, I have notions. I have Canadian hockey player clients included in my portfolio, have
Oh,
had
that's
for
great.
many years. So I follow a little bit, and yeah, I know Canada's very good. I know it's a religion in Canada. It's not just a sport.
It sure is. We were disappointed, a lot of us, that the Oilers didn't come through, but there's always next year.
Well, Edmonton's a great team.
Yes. When I,
See, I know something.
well, and of course, everyone knows who Gretzky is, and that's where he came, his hockey
Absolutely.
career was. So on to the stuff that we should get to regarding tax implications. I know you've prepared something for us to help us follow along because there's lots of things to discuss with this topic. So you can go ahead and put your screen presentation up and we'll dive right into it.
Okay. I'm going to go quickly, but we're going to recap uh, for questions to bring it down to earth. Okay, we've already discussed who I am. That's my contact information. Um,
Yeah,
for
and before you go ahead, I just want to
okay,
assure everyone that's listening or watching that we're gonna post Doug's contact information and everything. So don't feel bad that you missed that screen or whatever. It's gonna be there at on the presentation when we edit and send out the recording for you.
okay, back to the show. Um, FIRPTA is an acronym that you will hear if you're a non-U.S. person and you sell U.S. real estate. FIRPTA stands for Foreign Investment in U.S. Real Property Tax Act of 1980, which was the first time that foreigners actually paid U.S. tax on disposition of U.S. real estate. 5 years went by and they improved the law by including teeth. The teeth in the FIRPTA law is what people are commonly referred to as FIRPTA, which is the withholding tax. That didn't happen until 1985. It really hasn't changed much until today. So this is an old law, but it's a real law in terms of the withholding tax is a large number relative to the transaction. Um, it's the withholding tax is based on the gross proceeds without regard to whether the seller's made a gain or a loss. So you suffer a loss, you're as a foreign person, you're subject to withholding tax, which means um, let's let's take an example. Here, I'm assuming that Kim Jong Un the dictator in North Korea, has sold his Arizona vacation home to a U.S. resident. Her name is Liddell Lady Buyer, little old lady buyer, um, who is buying the house for $600,000. It's her main home. That's basically her only asset was that 600,000 she put into the hands of the title company, and the title company was aware that Kim Jong-un was a foreign person and therefore withheld the required 10% of the sales price, which goes to IRS. So you can, on the left-hand side of the screen is this, what happens in the transaction this year. There's a step one and step two. Step two, the $60,000 of withholding goes to IRS. IRS credits it to the seller's tax account. And then in year two, Kim Jong-un is required to file a U.S. tax return. And in fact, wants to file a U.S. tax return because at the end of the day, when he does file his U.S. tax return, he will have a refund from IRS of $30,000 of the $60,000 that was withheld from him the day of the sale. So why does the U.S. have this withholding tax? Well, it's because they've learned over the years that when a foreign seller gets the money back home, they don't do what they must do, which is to file a U.S. tax return and pay the U.S. tax, which Kim Jong-un's tax was $30,000. Since the withholding of 60, he got a refund of $30,000.
And after that, just so on that note, like when you said people don't do what they're supposed to do, and this is why FERPTA came into effect. So once someone, before that, once someone leaves the country, there's no way that the IRS can get that money, right?
Well, actually, the U.S. has a network of international income tax conventions, tax treaties with foreign countries that all have provision for assistance in collection. So in Canada, CRA would need to legally assist IRS in a collection action, which under the tax treaty, which would take a long time to do, and it's very rare that that's ever happened, but it could happen. But yeah, in general, this is the whole rest of the world that might have foreign sellers that owe U.S. tax, and IRS would have to send the people over there, which there are U.S. embassies with IRS tax personnel located there year-round who are obviously helping collect U.S. tax from residents of that whatever country they're based in. So yeah, IRS has a long arm. You know, so there you go. Should I get back rolling on the slides?
Yeah, please. Sorry for
Okay, so
interrupting.
first I want to introduce a news blurb. I don't know if everyone's heard, but Donald Trump has just negotiated a trade deal with Kim Jong-un. Speaking of the man in the example. So I don't know if everyone has heard about this, but it was quite a trade deal. It's first of its kind.
His hair looks pretty interesting like that on both of theirs.
All right. So seriously, when does FERPTA apply? 3 requirements. There needs to be a change of ownership. Think sale, but it's other forms of change of ownership, like contribution to a legal entity, distribution from a legal entity to its owners. Those are taxable transactions. So it's not just sales that come within the scope of the withholding tax. Is mainly what we're talking about here. There needs to be a U.S. real property interest, which is obviously real estate, but things that you wouldn't think of, like long-term lease. Golfing memberships, I think, fall within the scope of FERPTA. And corporate shares where more than half of the value of the corporation, the shares are considered real estate for purposes of withholding. Third requirement is the seller the transferor, because it's not just a seller, although that's, typically it's the seller, but it's the transferor that's subject to withholding, needs to be a foreign person. So when there's a U.S. transfer or IRS knows where they live, trusts them, and doesn't impose a withholding tax. But foreigners, yeah, they'd have to go over there to get the money. So that's why they made the law with the teeth of the withholding.
I'm very curious about the golf membership because, as you know, a lot of the reason why Canadians love Arizona is because of the golf. And so when you're talking about that FERPTA would apply to that, is that um, separate from the property itself, or can you expand on the golf membership
Yeah,
part?
it gets complicated really fast because there's no one single type of golf membership. There are equity forms of golf membership. There are contract forms of golf membership. But in general, I would say it's subject to FERPTA, but you need to look at actually what's going on before you can determine if FERPTA even applies.
Okay.
And usually the memberships are sold in conjunction with the property.
Hmm.
Sometimes not the same two parties. Sometimes
Sure.
it's the homeowners or the golf association that buys it back. So yeah, it's a complicated area. I wouldn't want to try to summarize that for you. Um,
But good to know.
yeah. So all right. So we're talking about, well, when is a foreign seller foreign, not U.S.? You need to know what kind of person it is. Person is either a human being, individual, or it could be a corporation, partnership, trust, estate, and various other vehicles. So, and the tax law is very specific and detailed because it's written by lawyers. We got plenty of them. So anyway, we'll jump through the different rules for different types of persons to determine whether they're foreign or not. Most foreign sellers are individuals. So this three-pronged test here. So foreign person is not a U.S. citizen. Foreign person is not a green card holder. That's a permanent U.S. resident visa. And it's not a person other than a U.S. citizen green card. A U.S. person can be a deportable alien under the immigration law, somebody that's here illegally, but has spent too much time here. So you spend too much time in the U.S., legally, immigration-wise, or illegally, immigration-wise, too much time on U.S. soil. Welcome to the U.S. Your worldwide income is subject to tax, but the good news is you wouldn't be subject to FERPTA, which is kind of bizarre, but so anyway, the substantial presence test is the too many days that I'm referring to, and it's kind of like we got you this way or we got you that way. We got you this way if during any one calendar year you've spent more than 183 days within the calendar year. Bingo, you're a U.S. tax person. Or there's a 3-year weighted average test of spending too much time. I won't go through the mechanics of it, but all 3 years worth of number of days on U.S. soil, whole or partial days on U.S. soil, come into the equation. People generalize, and it's interesting to say that if in 3 years in a row a foreign person spends 120 days on U.S. soil, so 4 months, no, 3 months, yeah, 4 months, spend 4 months on U.S. soil. They don't need to be contiguous 4 months. After 3 years, welcome to the U.S. You're a U.S. person. Um, so the next is, well, when is a legal entity considered a foreign person? There's a different rule for each different type of legal entity. Corporation, the test is where was it organized? A partnership, kind of the same test. Where was it organized? So organized outside the U.S., it's a foreign partnership or corporation. Organized in the U.S., it's U.S. domestic entity. LLC, I call it the chameleon under the tax rules because you first need to figure out, well, what is an LLC? Is it a corporation? Is it disregarded? Is it a partnership? Yeah, those are the three main ones. So foreigners can set up U.S. LLCs to own their real estate, but to determine the taxation, you first need to characterize, well, what is the LLC? Partnership, corporation, or disregarded? Then you apply the normal rule once you know what the LLC is. So it's either an individual, if it's a sole member LLC that hasn't checked the box to make a corporate election, it's disregarded. That makes the member of the single member LLC the owner for tax purposes. So it's an individual that's selling the property for tax purposes, even though there's an LLC interposed. If it's a 2 or more member LLC, by default, it would be a partnership unless it's checked the box to make a corporate election. So yeah, you get the idea. LLCs are a little bit complicated.
So it doesn't, in short, it doesn't matter, even though a LLC is an American entity sort of thing, but it doesn't matter if those are Canadians. It's still FERPTA will still apply.
If it's a U.S. LLC, so an LLC organized in the U.S., you don't know what the answer is yet. You have to determine, okay, well, what's the tax character of the LLC? Is it a corporation? Is it disregarded? Is it a partnership? If it's a partnership or a corporation organized in the U.S., it's a U.S. person.
Okay.
But yeah, so if it's it's single member LLC, having had no check the box election, and the foreign member, single owner member, is a foreign person, then FERPTA applies.
Okay.
LLC organized outside the U.S. is a foreign person by default, so FERPTA applies. So people die. Estates are U.S. persons if the decedent was a domiciliary of the U.S. in general. Trust, it's really complicated. It's crazy complicated to figure out whether a trust is a foreign or a U.S. trust. So we'll move on.
I have one question about the estate.
Yes.
So what if the property was owned by a U.S. citizen and was heired to Canadian, say their Canadian relatives? Would FERPTA apply then?
No, because way earlier on, a transfer by death is a transfer, but it's accepted from FERPTA. In fact, the last number 5 bullet point here, a transfer by gift, excuse me, transfer by gift or death is not FERPTA taxable.
Okay, good to know.
But there is a gift tax and there is an estate tax, which is really, really unfortunate for foreign individuals to encounter. Dying with U.S. real estate is problematic.
And what percentage is that estate tax?
It's a very progressive tax. In other words, the brackets are narrow and the rate goes up to 40% very quickly. Wow. And it's on the value date of death. So it's whereas Americans die, the first 13 point something million, 14 million today is not taxable at all. Foreigners dying with U.S. assets, there's no 14 million excluded, it's 60,000. So the value above 60,000, value date of death over 60,000 of U.S. assets is taxed up to 40%. Wow. Canada is very fortunate to have negotiated in its income tax treaty with the U.S. a very favorable provision where Canadians that invoke the tax treaty benefit by filing U.S. estate tax returns benefit from a pro rata amount of what an American gets, namely the 14 million of exclusion. The pro rata is a ratio of decedents, U.S. assets date of death divided by worldwide assets date of death. Okay. The tax return is a bear. It's very complicated to do, but it's worth it for Canadian decedents with U.S. assets. And it's something that you only get if you file that tax return. All right.
Okay.
So the other exceptions to FERPTA is if the seller's not a foreign person, um, there are, as we'll see later, reduced rates of FERPTA withholding. Sometimes the rate is as low as 0%. Well, there's no FERPTA for some transactions. There is the provision to request a reduced amount of tax or no tax withholding by applying to IRS. It's complicated and it's not working right now. Since COVID, IRS had said, yeah, we know that we're required by law to cooperate with this reduced withholding application, but we don't want to do that. So foreigners, it's beneficial for many foreigners to do it, but IRS is not playing that game right now. In an abrogation of the law, which is crazy. But anyway, go fight the government. Good luck.
Right.
The last exception we're talking about here is if the buyer is a U.S. federal, state, or local government, that FERPTA doesn't apply, which is a weird one. But I guess if you have government as a buyer, you're good to go. But you're still on the honor system. The withholding is just the first step. You still need to file U.S. tax returns even if there is no withholding. All right, the rate of withholding. This diagram is trying to describe the two-pronged test for what's the simple question, what's the withholding rate? All right, so there are three columns measured by what's the gross sales price. So to the far left, we have 0 to 300,000. The middle column, we have 300,000 to $1 million of sales price. And then to the far right, the third column is sales price over $1 million. You get three different answers to what is the right withholding tax. But it's a two-pronged test. So it's what's the sales price? The second prong of the test is crazy. What's the buyer's intention relative to the use of the property during the 2 years following the transfer date? And is the buyer an individual or a legal entity? So the way this chart's laid out, 300 or less, it's zero withholding unless the buyer is either not planning to use it as a residence or is taking title in the name of a legal entity.
And does it matter if they're Canadian as well?
It doesn't matter. It's
Okay.
the same. The buyer still needs to, you need to ask those two questions. Is the buyer going to use it as a residence, which a foreign buyer can do, a U.S. buyer can do? We'll talk about what is used as a residence in a minute. And then the form, the legal nature of the buyer. If it's an individual, you get the reduced 0 or 10 rate. If it's a legal entity, it doesn't matter what buyer intends to do. The rate is going to be 15. So red is bad, like stop sign, like a traffic light. Red is bad. Green is good. So here in green, under 300,000, and buyer intends to use the property as a residence and as a human being that takes the title in the transaction, the buy transaction. Zero withholding. Foreign seller likes that, but it's still on the hook to file the U.S. tax return and pay the U.S. tax based on the net gain the next year. Between 300 and $1 million, if the buyer meets the two-pronged test, it's 10% reduced rate. Unless buyer doesn't meet the two tests, in which case it's 15. Over $1 million, it's simple. It's always 15. Okay, when is a buyer considered to use the property as a residence? It's a little bit complicated to look at it, but it's important if it's a close call. But in general, if the buyer is going to use it as a main home, or use it as mostly a vacation home, use it as a vacation home more than rent it out to third parties, that's use as residence. So it doesn't have to be a main home, it can be a vacation home. but it needs to be primarily a vacation home. So what doesn't qualify? An investor that plans to rent it out more than use it him or herself or her family. Investor that plans to fix and flip. I'd say a legal entity buyer cannot use it as a residence. So there you go. That's basically
So
what it
you mean
is.
if you're buying it in your LLC name?
Well, if the buyer is a legal entity, there's no way the legal entity is going to use it as a residence. There's no provision in the law. It's not a human being, can't use it as a residence, and ergo 15%. But it's also by statute regulation, 15% if the buyer is a legal entity. So you don't get into the argument of is a legal entity going to use it as a residence, because it's a two-pronged test. If it's a legal entity buyer, you fail. It's 15.
Okay.
So the procedure, the title company, usually know what the steps are, but it's the withholding tax money needs to get to IRS within 20 days with a tax return. I call it buyer's tax return. Why? Because the withholding tax law makes the buyer responsible to get the money with a tax return to IRS within the right time frame, which is 20 days from the transfer, 20 days from close of escrow. And
So
if something goes wrong,
sorry, Doug, I just want to make sure that, because this is like the important part right now, I just want to make sure that we go really slow with this. So 20
right,
days of close. So that is the day that your property, it's recorded closed, correct?
right. The tax law says the date of realization of proceeds actually, but practically speaking, it's the close of escrow in a sale transaction.
Okay.
Remember, it's not any transfer subject to many. So yeah, close of escrow is usually the beginning of the 20-day clock. There are exceptions. Of
Okay.
course, it's
And let's talk
tax. There
about
always
this
is.
form. So my seller puts their property on the market, and they are Canadian. So what should we be telling everyone to tee up the second that they put their property on the market? Who should be doing what?
I'd say the seller wants to get a knowledgeable international U.S. tax professional on their side, certainly by the time they have a signed contract,
Okay.
and definitely before close of escrow. Why? Because there are a few things that seller wants to have lined up, will need to line up before close of escrow. Two primary essential components to what they want to do before close of escrow. They need U.S. tax ID numbers if they don't already have them, or if they've become invalid. They want to commence the application or renewal procedure to make sure they've got U.S. tax ID numbers. And they want to prepare that tax return that goes in with their withholding. Even though it's buyer's legal responsibility, seller has a vested interest that buyer's tax return,
Sure.
withholding tax return, is prepared correctly, because if it's not the next year, the seller will definitely encounter delays in recovering their excess withholding tax. In other words,
Which
once
I
they,
have heard many, way too many times happening. And I think that's because the seller and buyer aren't aware of, the deadlines that like we're talking about. So to everybody out there, it's just so important to surround yourself with the professionals that know about this, because let's face it, it's your money.
right, and things can and do go wrong. In this FERPA area, there's so many moving parts, so many people that have vested interests in it, because IRS is making buyer responsible. Title companies in the middle, they're legally liable, not to the tax man, they say, but both parties. So many moving parts. It's complicated, and it's a lot of money. 10 or 15% of the sales price, even of a small transaction, is a lot of thousands of US greenbacks.
Especially of the 1 million. That's a lot of money.
Sure, yeah, sure is. So, um, yeah, so the procedure, both parties need tax ID numbers. So not only seller needs U.S. tax ID numbers, buyer also, who could be foreign, could be a foreign buyer. I've seen Canadian to Canadian transactions of U.S. real estate. The buyers need to have a U.S. tax ID number too. And when they hear they need to file a U.S. tax return just because they're buying, their home or their vacation home, they completely, they get dramatic. It
Yeah, of
makes no
course.
sense. It makes no sense. But think of the Kim Jong-un seller scenario where you think IRS is going to go over there. Okay, there was a movie where they sent IRS people over, but um, yeah. So in 1985, the president and the Congress decided, yeah, we better put teeth in the law. We know where the buyer is. We can reach the property. So let's go after the buyer. So buyer is definitely hugely involved in the taxation relative to the sale. Okay, so the application for reduced withholding, it's a great deal to get IRS to agree to less than the 10 or 15% of the gross sales price amount of withholding. And it's especially wonderful if the sale happens early in the year, because not only would seller have less withholding, he'd be able to recover the excess withholding sooner than waiting until the next year to file his tax return. So let's step back for a second. So the general rule is the foreign seller suffers the withholding, which is 99% of the time too much money.
Mhm.
The vehicle to request recovery of the excess withholding is filing of the tax return, which by law cannot happen until the next year.
Okay.
So the year of sale needs to close before the tax return asking for the excess withholding back can be filed. That's the general rule. This application for reduced withholding is a mechanism to recover the excess withholding much sooner. In fact, within 90 days by law, and I've seen it happen within 50 days. I've actually, pre-COVID, I was getting refunds to sellers within 50 days. But since COVID, IRS has been saying, forget it, we're not doing that. Yeah, we know it's the law. We don't care. There's no penalty revision in the law to make us do it. So this is kind of a non-starter until IRS gets its act back together again.
Okay.
Maybe Doge will enforce it. I doubt it. Doge is firing IRS personnel.
Yeah, right.
IRS needs more personnel that know what the heck this is to implement it. So I don't expect this to come back online, unfortunately, for a while. It's too bad because it's very beneficial to sellers early in the year.
Okay.
Sellers late in the year don't even want to consider this because, well, you sell on December 31, you can technically file your tax return the next day to request refund of your excess withholding. So this is kind of the fun part, but maybe it's fluff. We don't need to talk about it. I get a kick out of all the crazy ideas that I have heard over the years. Um, it makes me laugh, but it's probably not so funny. But it does cover points of common misunderstanding. Uh, let's move on. We can come back here
Well,
later
this,
on.
believe it or not, I just briefly looked through this, and you have no idea how much I hear all of these. So I think it's really
I know.
important that we go through
All
these.
right. Yeah, and it makes me laugh too. So excuse the laughter. All right. So myth number one. Yeah, the U.S. tax cost is 10 or 15% of the sales price. In other words, the withholding is my final cost.
Right.
No, 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 no. It's just a withholding. It's like a refundable deposit. So don't freak out. It's probably too much. You'll get it back once you file your return asking for less, which you're entitled to by law. And IRS will issue a refund if your real tax is less than the withholding. Okay, myth number two. Sales price under 300,000. So yeah, I don't have to worry about U.S. tax. U.S. doesn't want a tax for me because it's under 300,000. Well, the root of this myth is that, remember, the three brackets of what's the right withholding tax rate. There was a big green 0%. A lot of transactions kind of fall in that category. Less than 300,000, and buyer intends to use the property as a residence, and the buyer is not a legal entity. A lot of sales fall in that category, and so FERPTA withholding's not required. But in that scenario, yeah, it's still subject to U.S. taxation, just not with the withholding. In other words, sellers got to file a U.S. return the next year and pay tax based on the net gain. Myth number 3. Well, we're close to, we wanted 350, but if we just reduce our sales price under 300, no withholding. Maybe even, myth number 2, no U.S. tax. All we got to do is give up 50,000 of what otherwise would have been sales price. Well, that's stupid. In as much as the withholding is not a cost, it's just it's kind of like a time value of money. It's like a loan to the U.S. government. You'll get it back, however much of it was too much. But you give away sales price, you're not getting that back. That's a permanent cost. So in general, never reduce your sales price. There's a conversation when you're talking about, okay, well, what if we sell the furniture as a side deal, or we sell the golf cart as a side deal to get the price under 300,000? That's a gray area, and you know what? Be real careful. Be real careful. Could be, yeah, maybe. I don't think it really works under pressure, but there's kind of an argument that maybe it would work. So anyway, but general rule is don't reduce your sales price to reduce or avoid withholding, because you're giving away money that would still be yours if there was withholding.
Because again, you're not back to myth number 1. It's not 15%.
Exactly right. It's not a permanent cost. It's only, it's like a refundable deposit. A reduced sales price is not refundable. That's money lost. Myth number 4. What? U.S. taxation? I file in Canada. I file back home. I've always paid my taxes in Canada, so I don't need to file in the U.S. Well, the U.S. doesn't think so. The U.S. says, hey, the property's on U.S. soil. We've got jurisdiction. And they'll pursue what they've got coming to them under the full capacity of their ability under the law and the tax treaty. Do they have enough time to go after you? Well, maybe not. But I don't think the buyer is going to go along with not applying FERPTA, because remember, buyer's on the hook.
Exactly.
If IRS is going to, and that's a lot of money, so buyers have a hugely vested interest to make sure FERPTA applies if it needs to apply. And then the title companies have been, in litigation with buyers or sellers that things have gone wrong. So title companies are kind of like the police to see why they're own it. All right, so
and it's important to everyone out there, the title company that you're working with, that they're familiar with FERPTA.
Yeah, it is. But you get a knowledgeable tax professional on your side up front, and you should be good to go, because I handhold a lot of title companies.
I'm sure you
They're,
do.
by the way, very happy to have someone knowledgeable involved. Mm-hmm. Okay, myth number 5, one of my favorite. I used to work in the U.S. I have a Social Security number in the U.S., so FERPTA doesn't apply to me. Well, no, that's not the test. The test is, are you a foreign person, have green card, citizen, or spent too much time on U.S. soil? Answer is no, you're foreign. FERPTA applies. Doesn't matter if you've got a Social Security number. It does save you the step of applying for a tax ID number, because a Social Security number is generally valid forever. But yeah, it's not an exoneration from withholding or from U.S. tax. Myth number 6. Oh, I don't need to apply for a U.S. tax ID number. I've got my Canadian social insurance number, and it's the same number of digits, and Americans aren't smart enough to know that all you do is just move the dashes. No, SIN is of no use down here in the U.S., even though some title company, how would a title company know otherwise unless they made you prove it? But if FERPTA applies, you want to make darn sure you've got a U.S. tax ID number that's valid, because you're not getting your money back until you've got a U.S. tax ID number, which you need to file the U.S. tax return, which you need to hope to get your money back. So the final myth, number 7, comes up from time to time. Oh yeah, well, I'm just going to set up an Arizona LLC, any kind of U.S. LLC, which is a U.S. person, and FIRPTA won't apply. Well, no, that doesn't work, because transferring the property to the LLC might be subject to FIRPTA right there, even though, really just file a $10 quitclaim deed and, hey, look at that. I just transferred it to my LLC. Well, the tax man isn't right there, but if they find out, they're right on the, they have a legal, they have the legal right to pursue FIRPTA relative to just the transfer of the ownership from the individual to his LLC. And then, as we said, an LLC owner of U.S. real estate could be subject to FIRPTA as well if the LLC is a foreign person, which it could be. So yeah, and myth number 7, you better consult somebody that knows.
What if one person is Canadian and one is American? They bought it together. Does it matter?
Well, yeah. So you have a joint, 2 sellers of one U.S. real estate interest. One's a U.S. person, one's a foreign person. You bifurcate the transaction. So the non-U.S. person's half, if it's a 50-50 split, would be subject to FIRPTA.
Okay.
And the U.S. person is not subject to FIRPTA. Both need to file U.S. tax returns to report their net gain.
Okay.
But only the foreign owner is subject to FIRPTA.
Okay.
Planning idea for all buyers: get a certification of non-foreign status before you do not apply FIRPTA. Buyer is subject to FIRPTA. Buyer can insist with a title company that they want FIRPTA complied with, and usually that works. Buyers don't want to screw up their transaction by insisting that FIRPTA should apply when clearly by law it wouldn't apply. But this certification of non-foreign status, it's an IRS concept, which is equivalent to, if you're familiar with the game of Monopoly, the get out of jail free card. A valid certification of non-foreign status is a buyer's get out of jail free card relative to FIRPTA, as long as buyer had no reasonable reason to believe that it was not a valid certification of non-foreign status. Okay. So what we're talking about here is the seller certifying under penalties of perjury that he or she or it is not a foreign person. And the buyer can rely on that as long as it seems to him reasonable that it's valid, that he's selling to a U.S. person.
So that certification, is that like
it's an affidavit. It's an affidavit, which every title company has one in their portfolio of things, which, by the way, they only give out when they think it's a foreign seller. They don't give it out to everybody, which has been, it's my recommendation. Hey, get a certification of non-foreign status from everybody. How do you tell a Canadian buyer, a seller, from an American seller if they're not honest about, their facts and circumstances? The buyer wants to make sure.
One says A.
Yeah, well, right. Maybe in Alberta, where the accent seems to be, the A seems to be prolific, but I don't think it's as much on the West Coast, on the East Coast. That A thing, I think, is in the middle.
It sure is. But yeah, how do you know? You don't know if by the person's accent or whatever. It should just be a standard mandatory form.
Should be for all transactions, but if the title company buyer doesn't hand it to you, ask for it. Seller will sign it for sure. If they're, unless they're perjuring themselves.
Of course, yeah, makes sense.
Okay, this is interesting for foreign sellers. What is the taxation on the tax return? So in Canada, you have a disposition of a capital asset, capital asset gain, where you pay tax on only half of the gain in Canada. The US has different nomenclature, but a favorable rule. We call it a long-term capital gain. If the seller has owned the property more than a year and sells it, the gain is characterized as long-term, and long-term gains have the benefit of being taxed under what you see on the screen set of tax brackets. So here we've got three different types of sellers. Single sellers. Middle bracket is married sellers not filing a joint return, which foreigners can't file a joint return. So all married foreign sellers are in that category, middle column. And then sometimes it's an estate or a trust that sells the property. Corporations are not on this table because corporations do not benefit from a long-term capital gain. It's a flat 21% federal for corporations. So the brackets are, the lowest, the first amount of gain. So for in the middle column, the first zero gain up to $47,025 of gain. Look at the tax rate over in the far left column. It's zero. That's a great deal. So a married couple of Canadians selling US can have $94,050 worth of net gain subject to no tax.
Mm-hmm.
It would all have been subject to FERPTA withholding, but when they file the return, the 90, what did I say, 9450 is no tax liability. They'd get back all of their withholding tax.
Okay.
And so that's the lowest rate bracket. The next rate bracket, 15% applies to gain 47,000 up to 291,850. It goes up to 20%, and that's the highest long-term capital gain rate. There's a 25% rate that applies to the depreciation, which is the American legalese name. In Canada, it's capital cost allowances is the equivalent of depreciation in the US. So this is only if you've rented the property out that there would be depreciation allowable. The depreciation allowed or allowable is subject to a 25% rate. So even if the gain is below the 47,000, any depreciation in there would be subject to 25% tax.
Now, this is a question I get all the time, and I'm not sure if you're able to speak to it, but this is the US tax rates. So they always say, well, what about, do I have to pay capital gains in Canada?
Okay. Well, you reminded me, the very bottom has a little notation that, well, don't forget, we've got two jurisdictions of taxation in the US, federal and state. Yeah, Arizona has its hand out. The good news is the Arizona tax rates are low. It's like 2.59% to 4.5% of the net gain. There's no withholding, and Arizona is not going to get a nickel of the FERPTA withholding, which is federal only. So
Okay.
foreign sellers of real estate in Arizona need to come out of pocket to pay the Arizona tax. And Arizona wants its money during the year. And if it's not paid in during the year, there'll be a finance charge. It's called a penalty, but there'll be a finance charge on the Arizona tax, not paid, on time during the year of sale. Now, to your question, which is a great one. So the Canada resident individual sells US real estate in Arizona, let's say. There are 4 tax jurisdictions that are involved in that one real estate sale. We've been talking about the US federal and the US state of Arizona. They have the first right to tax, but since the individual is resident in Canada for Canadian income tax purposes, Canada has the right to taxation. I call it on a residual basis. In other words, residents of Canada need to report to CRA their worldwide income, which would include gain on sale of an Arizona property. That's the bad news. The good news is that Canada has provision for mitigation, avoidance of a double taxation. That provision under Canadian tax law is called the foreign tax credit, which is essentially a dollar for dollar offset from Canadian tax of however much US federal and state income tax must be paid under US and Arizona tax law. So at the end of the day, it's sort of like, yeah, we'll make believe you that the Canadian investor, instead of having sold a US property, sold property in British Columbia and made exactly the same amount of gain. The taxation costs to the Canadian investor would be identical. It's just that all of the tax would have gone to CRA, and British Columbia, instead of some to IRS and Arizona, the rest to Canada, CRA. And British Columbia would get some of the residual tax too. BC or go ahead.
What about the currency?
Well, therein lies the difference in the hypothetical of, well, make believe the property was in British Columbia. If it was a Canadian property sold, there'd be no currency component of gain or loss. Whereas since the US property is denominated in a foreign currency, the foreign currency gain or loss would be included in the real estate transaction for Canadian tax purposes.
Okay, so the Canadian government is taking into effect the US dollar amount.
Gain or loss, right, inherent in the transaction. So simplified, the Canadian gain calculation is sales price at today's exchange rate minus purchase price at the historical US dollar Canadian exchange rate. That's the real estate and currency gain baked into one number on the Canadian tax return.
Okay.
All right, so we talked about transfer by death or gift is not subject to FERPTA, but it is subject to a tax that exists in the US that does not exist in Canada. We have a transfer tax when there's a gift of US assets or the transfer of US assets by death. And that taxation is very progressive, up to 40%. The tax brackets are very narrow. So in this example, let's say the property, US property owned by a Canadian domiciled decedent was worth 560 in the date of death because the Canadian decedent's estate is entitled to only a $60,000 exclusion, not a, well, I wrote 12 in this example. It's American would have gotten 14 million. Canadian domiciliary decedent gets only 60. The tax base for the US death tax, estate and gift tax, is 165,000 on the $500,000 of taxable base, which is a crazy amount of tax.
So I guess the word of advice to the Canadians, especially if they're older, is it
don't die, don't die, which is,
well, so
everybody knows that.
Is that when you change the title to, does it matter if it's a trust then, or if it's, or do they just put it in their kid's name, or?
Yeah, so,
because 165,000
right, so,
is a lot of money.
Well, take this with a huge grain of salt, because as I said earlier, a Canadian decedent wants to invoke the benefit of the tax treaty, which all the Canadian estate would need to do is to voluntarily file a US death tax return invoking the benefit of the tax treaty, which is to say, to file that tax return voluntarily invoking the tax treaty to increase from 60,000 of exclusion up to, towards the 14 million that an American decedent would get. And, typically that brings the death tax down very, very low and very often to zero, because 14,000 of exclusion, even on a pro rata basis, is a lot of money
And when
compared with 60.
would you do that?
The due date for the U.S. estate and gift tax return is 9 months after the death. However, I've never seen a decedent's beneficiaries come to me soon enough within the 9-month period. It's pretty rare, but
Yeah.
there seems to be, theoretically there is a long time available to file that beneficial estate and gift tax return to invoke the benefit of the tax treaty.
However, if you go
It's kind of like you definitely want to do it before IRS fines you,
yeah, right.
because by that time they may have the better argument that it is too late,
Sure.
and you only get the benefit if you've filed the tax return. IRS isn't going to say, oh, well, you could have filed that tax return, so we're only going to tax you as if you filed that tax return. IRS is not going to do that, because that's not domestic law. That's an exception under a Canadian contract. The tax treaty is a contract between our two governments. It's not part of U.S. law, but U.S. law has to recognize it if it's qualified for.
So is it better for, say, if you're elderly to put it in your kids'
Oh,
name?
right. That was your question. Sorry, I went off on a tangent.
It's
The
okay.
best time to anticipate dying owning U.S. real estate is before you acquire the U.S. real estate. And the cure may be more painful than the disease, because, well, let's say, corporation is one way to avoid a foreign corporation owning the U.S. real estate, is one way to avoid the U.S. death tax, because it's not a foreign corporate shares are not a U.S. asset, and therefore there is no death to be taxable in the U.S. But if a foreign corporation would need to collect rents, either deemed rents, even if it's its own shareholders that are using the property, or keeping the property vacant, available to the shareholders. So corporation vehicle to avoid the U.S. death tax comes with the downside of annual U.S. income tax returns for the corporation to report the rental consequences. Seems that an irrevocable trust can avoid the U.S. death tax, and
Canadians can take
would not need to be renting out the property to the principals for their usage. So that's favorable. Complicated. Does it really, really work under pressure? I don't think it's ever been tested in a contentious battle with IRS, but I think most international tax professionals would agree that, yeah, an irrevocable trust can theoretically, hopefully practically, avoid the U.S. death tax.
And how do they create that trust?
You go to an attorney that would be
A
willing,
U.S. attorney.
and you want to make sure qualified to create that trust in an airtight fashion
Okay.
to prevent the IRS winning the battle.
Okay.
But you want to do it before death. I mean, sorry, before acquiring the property, because in order to implement any kind of legal entity vehicle after acquisition involves transfer of the U.S. real estate to that legal entity, which would be subject to FERPA. So that's why you want to anticipate this. If you're going to go this route, do it before you buy the property, to avoid the FERPA consequences of rearranging your affairs, which would
But
be subject to FERPTA, even though
you
you own the
said
legal entity, it's
if they
still FERPTA.
file if they file within the 9 months of death, then they also are not subject to the estate tax?
They're subject to the estate tax, but as modified by the tax treaty,
Okay.
which the US-Canada tax treaty has a very, very favorable provision that entitles um, Canadian decedents a pro rata amount of the 14 million that an American gets.
Okay.
And actually a pro rata amount, I'll say, of what a surviving spouse gets. So it's kind of like pro rata amount of twice what an American decedent gets under the tax treaty with Canada, but you need to file to invoke that benefit.
Understood. Okay. Okay.
We mentioned that the estate and gift tax brackets are very narrow, very progressive. We said the rates go up to 40% on U.S. asset value over $1 million. Yeah. And that's it. That's the full extent of my slideshow. And that covers pretty much the range of subjects that arise. But every foreign seller has a different set of facts. And so it all depends. And the US tax law has exceptions. So it all depends.
Right.
And then Canadian law that's relevant to this has some provisos too. Kind of blows my mind that a Canadian with, let's say, an Arizona vacation home can designate under Canadian income tax law the Arizona vacation home as his primary principal residence, exempt from Canadian income tax. What? Canadian law allows that? Yeah, apparently. The US law, now we have an analogous provision that no. That can't work. It's got to be your main home. Have
It's
you
like
spending
primary residence.
how many nights have you spent there with all your
Yeah.
stuff? That's the
Right.
only way you're going to get it. But in Canada, you can just say, I want it. You got to give it to me, revenue agency. So, but the US doesn't recognize a Canadian principal residence argument. It's irrelevant. The US law would still apply. So even though there'd be no Canadian tax done right being you've elected it to be your primary in Canada, exempt from Canadian tax, you'd still pay full bore US tax.
Very interesting, informative, and kind of overwhelming, but that's why we have you to reach out and explain this more in depth if people want
Sorry.
to.
Don't shoot the messenger.
Yeah, I know. Well, that's, it's your wheelhouse. So, but definitely very enlightening. Everyone, I know it's summer there. If you're thinking about selling your property in Arizona, you can reach me at 480-822-9416, Canadian Realtor in az@gmail.com. I know it's beautiful time of year in Canada because I'm originally from Regina, so I love the summers. It's 45 degrees here, so it's a little toasty. So if that if that comes into your mind about selling, please reach out to me. And if you have questions for Doug, we're certainly going to post his information as well, so that you can be prepared for when you make that final decision. We're going to have another episode of this podcast in July. I hadn't really picked the topic yet, but you definitely gave me some good ideas as far as how we can hold title and all those complications that go with it. So once again, Doug, thanks so much and have a great weekend coming up.
My pleasure. Thank you very much.
Okay, take care. Bye-bye.